talk today about dividends, and dividends is a harder topic in taxation than most people realize. There's some little twists that make it a little bit more interesting than plain vanilla. So let's start off with what we're most familiar with, ordinary dividends. And that's a distribution from stock shares and distributions from money market funds. Now, we think about money market funds as being savings vehicles, and they are, but they pay dividends. Mutual funds also pay dividends, and all payments, however you get them, of dividends are classified as ordinary for tax purposes initially, and taxed as ordinary income. So, if you get a distribution from money market fund, and I'm concentrating on this because I think most people find it confusing, because that's interest. It is taxed as ordinary income because it's an ordinary dividend. That's the same rate you'd pay if it was treated as interest. So don't say, oh, the government's taking more. No, they're not. It's the same rate. It's just a different line on your tax return to put it on. So let's talk a little bit more about qualified dividend. What makes a dividend qualified? Let's start with the money markets. They are never qualified dividends. They are specifically excluded from being qualified dividends. So even though they come out on your 1099 dividend and they're really interest, they kind of keep their identity for tax purposes as interest. They're ordinary income. All interest income is ordinary income. So there's no difference. It's just a different line, again, on the tax return. But what is a qualified dividend? A qualified dividend is a dividend payment paid by a U.S. corporation or a foreign corporation, and the foreign corporation needs to be located in a country that the United States has a tax treaty with and publicly traded on a major exchange. These dividends are eligible to be taxed at a lower income tax rate, the capital gains rate, and the capital gains rate runs from 0 to 20% depending on your income level. But they must meet two criteria, and people forget about the criteria. The first criteria is that it must be from one of these corporations that we've already defined. The second criteria is that you need to hold the security for 60 days before or after the dividend payment date. Notice that's a 61-day window because the payment date doesn't count. So it's 60 days before, 60 days after. The day it gets paid doesn't count. If you purchase it, that doesn't count. That's not your first day of holding it. Your first day of holding it is the next day. Now, why is this important? We're all used to getting our 1099s when we do our tax returns. And box 1 for 1099 dividend is ordinary dividends. Box 2 is qualified dividends. Qualified dividends, if you read the instructions that come with those lovely forms in that little print, says these are dividends that are eligible, and note that word in there, to be treated as qualified. It doesn't mean that they meet both criteria. All of them will meet the first criteria to be put in that box, but the second criteria may not be met. The burden is, unfortunately, on you, the taxpayer, to figure that out. Now, some brokers provide you with that information and supplemental information and will tell you how much of your dividend, ordinary dividend income, actually meets the qualified standard for both criteria. So that's something to look for and make sure that you're checking on your tax return. Just don't take those two boxes and plunk them down there. There might be a reason to change that number in box 2. We've already talked about it being the long-term capital gains rate that applies for qualified dividends. So it's a lower rate than the ordinary income rate. So that's something to just remember as you go forth. I want to go back to money markets. Money market funds pay dividends. And I can't stress this enough because I think a lot of people find this very, very confusing. We are so used to thinking of money markets funds just like our checking accounts because we can write checks from them, our debit cards can go to them, our charge cards can be paid from them. So we think of them as just a fancy checking account that bears interest. They are not. They don't bear interest, they bear dividends. Their dividends, and I've said this earlier just a few minutes ago, can never be qualified. You always pay the ordinary rate. The ordinary rate is the rate that applies to interest. So they end up being taxed the same way. Again, different line on your tax return. But I just want to repeat that because I do think it's very confusing. Mutual fund dividends. Mutual funds can distribute ordinary dividends. They can distribute ordinary dividends that meet the criteria of qualified dividends, short-term capital gains, and long-term capital gain. And they're all called dividends, but they're really distributions of long-term capital gains and short-term capital gains. The source, the underlying source within the mutual fund determines what kind of dividends they are. So let's use an example. If you own a mutual fund and it pays you a 50-cent dividend on all your shares, and we're just going to use the 50 cents. 25% of it, or 25 cents of it, it pays you dividends on all your shares. So you're going to get 50 cents a share. 25 cents of that dividend might be ordinary dividend, and it also might meet the criteria to be qualified. So remember that qualified dividends are always included as ordinary incomes. They're adjusted, so it's a breakout of the amount that's eligible. And then the other 25 cents of the 50 might be made up of 5 cents of short-term capital gain and 20 cents of long-term capital gain. And it goes on a different box on your 1099 dividend. So make sure you get your boxes right when you enter it into your tax programming. It changes the rate. Those long-term capital gain dividends are taxed at the long-term capital gain rate, which again can run from 0 to 20% depending on your income level, or rather than the ordinary income rates, which are always higher.